Hi, I'm Geoff Ebert, Senior Solicitor and founder of Your Super Split. Today is the first in the series of a number of short videos explaining the division of superannuation and explaining the process generally in relation to property division upon the ending of a marriage. The first couple of topics we'll deal with today is what is superannuation and how do you value it? Well, most people know that superannuation exists because those people who are working have their employer make payments into a superannuation fund. And that's what we're generally talking about. So we're talking about the balance of monies that are payable to a husband or a wife or a couple if it's a de facto relationship that forms part of their asset pool in the event of a separation and needs to be considered if it needs to be divided. So in that regard, when we look at that, we're talking about, well, let's say it's a husband and wife situation. The wife may have $150,000 in superannuation, and the husband might have been working a couple of different jobs while the wife was otherwise raising the children and has approximately $400,000 in superannuation. So between them, they have $550,000 worth of super, which is quite a lot when you compare it potentially to the fact that they might have the same amount of equity in their house. So in giving consideration to dividing property, you have to give consideration to the valuation of the superannuation, which we do know you can't take as cash when you divide it, but you can split it between the parties' superannuation accounts upon finalising a property settlement. The other thing is, how do you value super? Superannuation is valued essentially in two ways. Most people have what we call an accumulation account, which means that when you look at your MyGov balance or your superannuation statement from your super fund, the amount that it states there is actually how much super you have. That's called an accumulation account. The other balance that is somewhat more complex but less common is called a defined benefit balance. Now, a defined benefit balance is some federal employers or employees of federal government organisations have a defined benefit account, and the balance of their account is actually worked out as a multiple of their salary and also how many years they've worked in the fund. So sometimes we have to get superannuation valued by a valuer to determine its value so that you can work out how then to divide it. So the first steps in a property settlement and involving superannuation is to work out, do either of the parties have some superannuation, and then get a valuation to work out how much it's worth, if necessary. So that's step one on the road to a property settlement involving super, and I look forward to explaining more to you over the coming weeks.